Mark, you sure?
Yeah, it's time to call bullshit.
Bullshit on what?
Everything.
So is it really that time to call bullshit on everything? Nobody knows, but investing doesn't have to be binary. You can be bullish in some sectors while bearish in some other sectors. My portfolio always has long and short positions to cover different plays. In this video, I'll talk about 100 plus ways to short the market. Before we start, let's answer a couple questions as stated in this video. It'll greatly boost your returns if done mindfully. What are you shorting? Is it individual stocks, the whole market, the Dow, the S&P, Russell 2000, Nasdaq, or China? Or is it individual sectors, consumer goods, financials, utilities? You need to be precise on what you want to short. What is your shorting time frame? Is it a 1 week earnings play? If you expected Nike to do poorly over the last quarter, then you short for the week. Is it a 3 to 6 month short-term trend? If you expect Biden to win the elections and the market will crash, then you probably should start planting the seeds. Not 2 days before the poll results when everything's priced in. Is it a 2 to 5 year macro outlook where you expect the pandemic to cause a depression in the economy, as Ray Dalio predicted? How are you planning to short it? I'll go through 7 different strategies I've used, and there are pros and cons to each of them. Number 1, straight up shorting a stock. What do you need? A margin account. Whenever we short a stock, the downside could be unlimited. Say if we shorted Tesla at $1,000, the stock can continuously go up like a rocket to infinity and beyond. Therefore, our losses would be infinity minus $1,000. But the upside of shorting is only 100%, since the worst that can happen to Tesla stock is going to 0. When we first approached the stock market, we were just taught the buy and hold strategy, where you buy low, sell high, and profit from the difference. Shorting is the exact opposite, where we sell high, buy low, and then profit the difference. But there's one critical thing you need to know: the cost of shorting. Essentially, we need to borrow the stock from another client through the brokerage, and each day we hold that short position, there is a fee. And the fee varies depending on what type of stock you're shorting. For example, a huge blue chipper like Apple or Microsoft should cost maybe just 2 to 3% to short. But some of the highly volatile bankruptcy-prone stock could cost up to 50% annually to short. I'll go through one of my shorting positions as an example. I've been shorting GameStop for the past 3 years since it was about $22. Now it's worth $4. On the surface, I've made 80%, right? But in reality, I might have lost money. This table from the end of 2019 shows the quantity I shorted, 2,000 shares at $7 for a total of $14,000. But look at that glaring fee rate, 30%. That means I'm paying close to $5,000 per year in order to short the position of GameStop. Although I can expense a borrowing fee to balance my taxes, it's still a rough investment. In my opinion, the next couple methods would have better efficiencies. Number 2, buying inverse ETFs. This is definitely the easiest way to short the market. There's no need for a margin or options account. There are a few firms that provide these simple bearish ETFs. Proshares and Direxion are the bigger ones I'll briefly go through. I'll share the links down below. If we click into Proshares, we see a plethora of bearish choices. S&P, Dow, small cap, mid cap, you name it. And many of them offer 1x, 2x, 3x. For example, let's look at the ticker SPXU, Ultra Pro Short, meaning 3x bear on the S&P 500. If we type that into Finance Yahoo, we see that the ETF has gone up 6.1%, but wait a minute, the S&P on Friday has dropped 2.42%. Something is fishy. 2.42 times 3 is 7.26, not 6.81. Where is my 5%? We need to understand that the companies who offer the ETFs has to make money as well. The analogy is like playing baccarat or poker at the casino. There's usually a 5% rake for the house. That's to pay for the employees, rent, marketing, your free drinks, whatever. If we scroll down, we see there are so many sectors to short. Let's click into one of these and find out what the compositions are exactly. Dow Jones Industrials. From its name, I would have no idea what's inside this ETF. If we look into the fact sheet, we see that the top holding is PayPal. What? That's not what I expected at all. The other holdings make sense sort of, Honeywell, Boeing, 3M. Then it shows the index sectors, 30% capital goods, 20% software, 12% transportation, etc, etc. I'd highly suggest that you look into the ETF's fact sheet before buying into it. Let's look at one more example, Dow Jones US Technology. Again, it's a little surprising, not because of the stock choices themselves, but its weight of each one. This one has almost 40% weight in Microsoft and Apple alone. What if I mainly wanted to short Zoom? For example, if you want to short the tech sector and somehow bought the S&P 500 Inverse ETF, only 25% of your money would be working with your vision, since S&P 500 has about 25% tech. Even though the ETF would still fall along with tech, since they're the pillars that are supporting the markets right now. Another choice is Direxion ETFs. They have so many other options, shorting bonds, gold, international equities, etc. One thing I like about them is that their ticker symbols has a meaning. Need, N-E-E-D, for consumer staples. Cure, C-U-R-E, for healthcare. Nail, N-A-I-L, for home builders. It's quite clever, especially to target beginners. We'll look into one of them, Daily Communication Services Index Bear 3X, MUTE, M-U-T-E, top holdings, Facebook, Google, Netflix. But they carry both Class A and Class C shares of Google. I really can't justify that. So this fund has close to 23% in just Google. When we type in MUTE, M-U-T-E on Yahoo Finance, we see that their net assets is only $375K. Compared to the $1.33 billion in the Proshares SPXU we looked at earlier, this is minuscule. So I would probably go with Proshares ETFs since the net assets is much higher, making the funds more liquid. The last thing you want is for the fund to be delisted on various exchanges like what happened to TVX. Number 3, short call option. This method requires a margin options account. Essentially, we're putting a ceiling on the stock within a certain time frame and collecting the premiums if it doesn't hit the target. Last week, I opened several positions to illustrate the concept. Boeing and Nikola. BA September 18th, 2020, $300 call. I sold this at 6.35, which cost $635. At the time of shorting, the stock was worth $190. I was just implying that I don't think the stock can continue this huge rally back to $300 by September 18th. If it moves sideways, choppy sessions down or slightly up, my call option will still be profitable. For the last week, the stock dropped to $170 or about 12%. If we look into my options details, there's already $411 unrealized profits on this trade. And that's because the upwards trend has broken, and it's more unlikely it'll rocket back up to $300 anytime soon. Another example is Nikola, a very overhyped stock in my opinion. Nikola, January 15th, 2021, 130 call. I sold $1,000 for 2 contracts. I opened this play when the stock was up to $70. Essentially, I'm seeing the stock won't double within the next 6 months. Even if the stock goes up 20% with the massive pre-order numbers on Monday, I just don't think they can deliver on time, quality, or budget. The stock trended downwards by 10% since I sold the call option. Right now, I'm about $315 in the money if I cashed out, but I'll probably watch how the story unfolds to collect the rest. In both of these cases, if I were just to short the stock with the same amount of money, $635 on Boeing, $1,000 on Nikola, my profits would have been $80 for Boeing and $100 for Nikola. The shorts have earned $411 and $315 respectively. But I am risking more since one option contract represents 100 shares. Number 4, long put option. This method requires an options account. It's a home run bearish play, limited downside, unlimited upside. In simple terms, if the stock falls below my strike price or has a momentum towards that direction within a given time frame, then I would be profitable. I'll show you 2 examples as well, American Airlines and Boeing. AAL, August 21st, 2020, $14 put. When I opened the play, the stock was at $17 for $226 premium per contract. Even though the stock price has dropped 25% over the last week to $12.20, the premium is only at $3.30, a 50% gain of $239. That's mainly because of the stock's high delta and how volatile it's been over the past couple months. If it was Apple or Microsoft that dropped 25% in a week, these premiums would have at least tripled. Another example is Boeing. BA September 18th, 2020, 130 put. When I opened the play, the stock was at $190. Cost of contract is $621 premium. Even though the stock has dropped 12% over the last week to $170, the premiums haven't moved much to only $695, again due to the high volatility of the stock. The gains here is only $75. Comparing to the straight up short of a stock with $451 on AAL and $621 on BA, the profits would have been $112 on AAL and $75 on BA. But the long puts have earned $239 on AAL and $75 on BA. Number 5. Combining the short call and long put options. I'll go through in the next video why I love this strategy the best. Stay tuned. There are another 2 ways to short the market. It's to play options on the ETFs. So you can long call the Inverse ETFs or long put a bullish ETF. Doing it this way with options will magnify both your risk and reward. All in all, I believe shorting is an art, especially with option strategies. It's not for everyone, but the ones who can adapt and use the proper tools under various market conditions will prosper. Please consider liking the video and subscribing to the channel if you found any value at all. This greatly supports the channel. Thanks for watching, and I'll see you in the next one. Shh.